Well, consumer prices showed a faster year-over-year increase in July compared to the previous month, as CPI rose 3.2% in July. That's a slight acceleration from June's 3% increase, and it's still well above the Federal Reserve's 2% inflation target. San Francisco Fed President Mary Daly spoke exclusively with Yahoo Finance this morning and had this to say about a potential rate cut this year.
We are a long way from that kind of conversation. We're right now trying to decide if the policy rate is high enough to be sufficiently restrictive if we held it for some time. But definitely you're bringing up a conversation that I expect we'll be having next year. I just can't tell you the answer to that conversation because a lot of that's going to depend on, the vast majority of that will depend on the economy and the path of inflation.
For more on what this means moving forward, we want to welcome in Jeffrey Kleintop, Charles Schwab, Chief Global Investment Strategist. Jeffrey, good to talk to you today. So Mary Daly, they're saying that the conversation really is about whether those rates are high enough. But even if they are high enough, at the end of the day, it feels like we're going to be at these elevated levels for a while. What does that data point today tell you? What's your takeaway?
Well, I think that we need to look at the bounce that we're seeing today in the headline number as not being transitory. Inflation is going to be much harder to push down from here, meaning we've gotten used to this steady drumbeat of lower and lower numbers, and now that's being interrupted here. One driver for this is energy prices. U.S. oil inventories have been tumbling. The supply side is tightening as OPEC leader Saudi Arabia delivers on that hefty 1 million barrel per day cutback pledge for this month and next month, and said they could even go further. And CPI is now facing resistance to going lower from housing, which nearly makes up all of CPI in the U.S. at this point. But an adverse commodity price shock, as Mary Daly points out, while it's a real possibility, well, I'll say especially given the El Nino extreme weather impacts on supply chains and production we could see later this year, we don't think that necessarily would mean that the Fed would hike rates. In fact, in the past, the Fed's reaction to a surge in commodity prices or some kind of commodity price shock has actually been to cut rates rather than hike them.
So, Jeffrey, given all that, I was going to ask before that last point there, do you think the market is being too optimistic then when it's looking at this print? Or given what you just said there lastly, maybe they are reading this correctly?
Well, I mean, the Fed can't completely take rate hikes off the table, although we believe they're done. And I think that means there'll be still some lingering concern about when can they really declare victory over inflation and when might they begin to cut rates. I like to look at Brazil. Brazil began to hike rates 1 year before the Fed did. They paused rate hikes 1 year before the Fed did to the month. And maybe they've now started to cut rates. So maybe in August, next year, we start to see Fed rate hikes, cuts. If that's the case, that could be a little disappointing to a market that's already expecting rate cuts sometime early next year.
Jeffrey, you talk about central bank over in Brazil, but when you look at the major central banks globally, you've sort of highlighted this divergence we're starting to see. Obviously, the Fed has been out in front, the ECB a little behind, and then the BOJ just now trying to tweak that yield curve a little. What does that growing divergence mean for markets? To what extent does that inject more volatility?
Yeah, I think it does inject more volatility when we start to see this departure. We're so used to everything being in sync, and now we kind of get this divergence, and countries are looking at different levels of inflation now. Again, maybe it's stabilizing a little bit here in the U.S., not quite getting down to 2, but we're still seeing plunging inflation in Canada. It's coming down to the U.K., but it's still high. So we're at different points in the cycle, and that can mean more volatility in currencies and more volatility in the markets. It's noteworthy that the VIX really came rocketing higher on that news that the BOJ was going to be changing their yield curve control. And that's because the VIX was frankly too low at 13, the lowest level since prior to the pandemic. The markets were just not braced for any event that could drive volatility. And I think there will be a number of events that could drive volatility in the second half of this year. That doesn't mean stocks have to go down. It just means the ups and downs are going to be more frequent and more dramatic.
So, Jeffrey, given that, then what should investors do? How do they protect their portfolios against some of that expected volatility?
One of the things I want to do is focus on markets where they're not priced for perfection. And one that stands out to me is Europe. Eurozone valuations are below average. The current price to earnings ratio based on the next 12 months of earnings for the Eurozone stock market is 12.4. That's below its 10-year average. And I think investors may begin to recognize the durability of this index. It's now outperforming the U.S. this year. And, the U.S. stocks obviously trading above their long-term price to earnings ratio do suggest maybe there's some risk and some vulnerability to any disappointments that might come along with this inflation data, disruptions tied to El Nino effects later this year, or changes in policy, particularly given the particular volatility around China's approach to managing their economy. So lots of potential risks there. I'm favoring those countries that are not priced for perfection. I find those overseas.
Jeffrey, what about the fixed income space? I mean, you were sort of highlighting what we're seeing in central bank policy. In many ways, what we're seeing abroad, not just the ECB, but a place like the Bank of Japan, could really affect treasuries at a time when we have seen higher yields. How are we likely to see that shift up, and where are you positioned in that way?
Yeah, so interest rates are stubbornly higher here, and I guess they've come down a little bit this week, but overall, they've been moving higher. What I'm finding is that shorter duration stocks, companies that get more of their cash flow in the near term, the way out in the future, are behaving really well. They've actually been the outperformers since interest rates began to rise back in August of 2020. And now with the yield curve changes from the Bank of Japan, returning money to Japan, that yen carry trade unwinding, there might be more upside to interest rates and borrowing costs. So companies that can fund their operations out of cash flow are being valued more highly by investors. We're seeing those shorter duration stocks based on low price to cash flow ratios really outperforming here. They stumbled a little bit with all the bank concerns earlier this year, but they're back outperforming again. I'd advise investors to take a look at that characteristic, low price to cash flow, as a winning one for the remainder of the year.
So Jeffrey, here we are almost in the middle of August, that second quarter earnings season. We're getting towards the end of it. We've seen a significant number of beats, 79% of companies posting earnings beat when we compare that to analyst expectations. What's been your big takeaway from earnings season so far?
Layoffs is what actually stood out to me so far this earnings reporting season. Sure, a number of companies are beating, but one of the reasons is, they're kind of looking at managing labor costs. We saw Canada's unemployment rate rise for the third straight month in July, joining other G7 economies. And what I'm seeing is that the commentary from business leaders so far this earnings season is reflecting more layoff announcements. Words like reduction in force, headcount reduction, job cuts, outnumbering those that talk about hiring or labor shortages or difficulty in filling positions, which had dominated calls all last year. And we're hearing this not just out of technology. We heard that maybe last quarter. Now it's CVS, it's InBev, it's Biogen, Qualcomm, money manager T. Rowe Price. So it's not just concentrated in tech. We could be starting to see a turn here in the global labor market with broad ramifications for investors. Remember, usually corporate leaders tell shareholders before they actually start to make those cuts. So we'll have to see how that begins to affect things here as we look out to the third quarter and beyond.
What does this also mean for labor costs? I mean, that's been one of those areas that we've heard, right, from so many of these companies that have been reporting their results, how much they've, for example, had to increase prices because the labor costs going up. I mean, are we going to start to see a pullback on the back end there, too?
We could begin to see that. I guess Disney maybe hinted a little bit about that at the end of the day yesterday with their report, that maybe we're starting to see a little bit of an ease in some of those labor costs. I know it may not feel that way right now, given all the strikes taking place, but I think they're a lagging indicator. In general, what we're seeing is a tremendous easing in the demand for workers. We're seeing the job openings begin to fall. Like I talked about here with layoffs on calls, we're starting to see a number of countries now with 2 or 3 months in a row of a rising unemployment rate. So I think some of those wage pressures are going to begin to fall, perhaps in lagged effect here with inflation, and that should begin to brighten up the bottom line a little bit, but we have to temper our enthusiasm because at the same time, of course, that can mean less revenue growth as those workers also have less fuel for consumption.
All right, Jeffrey Kleintop, always great to get your perspective. Charles Schwab, Chief Global Investment Strategist, thanks so much for joining.
Thanks for having me.